Okay, let's move on. Let's talk about metals and let's talk about whether or not they actually have come in the value zone or not. And of course, the kind of volatility that one has seen in the markets. We have with us Aashish Somaiyaa, the CEO at White Oak Capital Management, joining in on the show right now. Aashish, hi, great to have you on the show. First, Aashish, just a word on the markets. And we were just chatting with Samit Vartak a short while back as to, how investors are waiting for when the pain and poison is going to get out of the system. I know we can't time the market. That's going to be foolish. But one is wondering if it is a bear market and if it has just started, how long are we going to have to sustain the pain?
Yeah, I mean, definitely we've been through a fair patch of, bearish sentiment. But then the question is that, is this bearish sentiment got to do everything within our borders, or is it kind of being imposed on us and we are forced to empathize or sympathize with the rest of the world? So I just say a couple of things. I think where we are in our economic cycle is not comparable to where the US is or where China is. And where we are in terms of our sources for inflationary pressures is also not comparable to where the rest of the world is. I think these are just a couple of observations. Second important thing is that, all the FPI outflow that we are seeing, in my experience, after the global financial crisis, there are just three occasions when we got massive FPI inflows. One was 2009-10, second was post the taper tantrum in 2013, and the third time was post-COVID. So whenever there is a crisis, there are huge outflows, and every crisis is followed by some kind of mean reversion or some kind of normalization. So bearish sentiment is well and truly accepted, no doubt about it, but we need to go behind and see the causes for that, and then we need to see how much we want to sympathize with it.
You have a great handle on how the retail sentiment as well is moving. Up until now, we've not seen large big ticket redemptions coming in. But do you fear that, one could see the DIIs as well pull out from the markets up until now, which was a very FI restricted issue?
Yeah, so I can tell you one thing based on my observations, that I don't fear any redemptions in the foreseeable future. There is a reason for this. Not that I would take any investor or any investor sentiment for granted, but my observation just tells me that investors don't want to withdraw money when they are 10, 15, 20% down on their portfolio. The second good part is, not so good, but relatively good part is that we've seen the market slowly kind of dwindle down rather than giving a big crash. So right now, for example, if there were to be a sudden further accentuated fall in the market, the first response is likely to be buying from domestic investors. Second is that if it falls and remains there, you are actually running the risk of inflows dwindling away. See, the first reaction always is that when there is a big fall in the market, right now the market has been slowly coming down. So at every level, there is slow and steady buying which is happening. If there's a sharp fall, I would anticipate that there will be more buying. If it remains low, or if it remains where it is even now, for example, if it remains like this for another 2-3 months, we are running the risk of inflows dwindling or inflows tapering off. Your specific question was on redemptions. I think we will get redemptions if from here, if we swiftly go back to 17,500 or some such number, redemptions will start. Because people generally don't want to redeem at a loss. But yes, after you have given them reasons to fear about their money, whenever the market comes back to, say, close to par value or comes back to previous highs, there is an instinct to, take the capital and scoot. So redemptions would happen only if we see a sharp up move. But right now, we just need to watch for inflows rather than worrying about redemptions.
Well, we've seen the DIIs and the retail investors be what the finance minister calls as shock absorbers for these equity markets. But Aashish, just taking forward that conversation, this is Nentara joining in. spoken about bear market rally, redemptions, this and the other. What we are now seeing is also investors bracing themselves for negligible to negative returns. You've had influential brokerage firms which are cutting down their nifty year-end targets as well. Is that what you're doing, and also telling your clients that this is going to be a year where you will make negative returns? Or that's not understood, or that's not for sure?
No, look, Nayantara, the point is that in any given year, the long period average is 10-12% for Sensex and Nifty. And in any given year, 20% up, 20% down is par for course. The great part about 2022 is that 20% down has come already in the first half. So I would stick my neck out and say that if you ask me 1 year from here, my sense, no expert really, it's almost like a coin toss. But yeah, if I still have to stick my neck out and make a guess, I think the good part is that the first 6 months have already given us the negative 20. If you ask me 1 year out from here, we will be in better territory. That is one thing to keep in mind. Second thing is that no, we are actually the challenge with buy side managers, or the buy side guys, or asset management companies. Biggest insinuation is that we are always telling people to keep accumulating, and at every time we keep telling people to keep investing. So I would put it this way, that even if you don't listen to us during bullish times, make it a point to listen to us when things get really bad. I personally believe that right now we are getting the short end of the stick for global reasons, whereas our own causes for concern are relatively transitory. I can't say that for US or for the rest of the world, but for us, I can say that this is transitory. That's why I said I'm looking forward to 1 year out rather than worrying about what is happening right now.
So tell me something, Aashish. As you prepare for that, look at that 1 year ahead window, how are you reworking your portfolio for the next bull run?
So, Nayantara, we are not actually, we are not sectoral or macro or top-down investors. Look, we at White Oak, we believe that our responsibility is to consistently outperform. BSE 500 total return index is our benchmark, and we think that our aim is to consistently outperform it by as high a margin as possible. So from that perspective, while we do stock picking bottom up, risk control is always top down and is always relative to what the market and the benchmark is doing. But I do guess, obviously, that your question is driving more at preferred areas or sectors, etc. So from that perspective, I can tell you that what finds good representation in our portfolios is private sector banks. My sense is that that is something which is bearing the brunt of what is happening in the market, but not so much to do with fundamentals. Second is, if you ask me, consumer, for example, has underperformed for long, and maybe even IT. I was just hearing a previous discussion, and I do kind of understand that a lot of the commentary coming out of the US is that while economic conditions are not that great, but it's not necessarily impacting IT spends and not necessarily impacting the strategic outlook towards IT services. So I think private sector banks, IT, this is what finds representation in the portfolio and will continue, at least like you said, from a 1 year out perspective.
Aashish, I'm wondering whether you're sporting a bear market look.
No, this is how it always has been, and I'm not bearish really.
Okay, anyway, I won't put you in a spot there, but good chatting with you as always, Aashish. Thank you for taking the time out.
Thank you for having me. Thank you.